Welcome, everyone. Excited to have a conversation with you all today about a very interesting subject. I've got Lennard Christensen on with me today, another member of Mountain Crypto Advisors, and then myself, Blake Schaper. Before I give an intro to you, Lennard, I was going to kind of give some context as to what the heck we're talking about today, because it's a nuanced subject and it's a conversation that not many folks are talking about within the community, that is just another tool in the toolbox when it comes to planning. And if anyone in the audience now watched the previous webinar we did, we covered a lot, which was really intended to be kind of a high-level overview of what Mountain Crypto Advisors is and what we're trying to accomplish through the planning and structures that we put in place. But the first thing we told you on the previous webinar, which I'll reiterate here, is we're not transactional partners. We're not trying to sell ink on a sheet of paper. If you want a trust document or an operating agreement, you can find an attorney in your backyard to put those items together. We're selling a team here, which is more than just the legal documents that get the plan set up. But we're also not selling a cookie cutter solution. It's one of the things Lennard and I were talking about before the call, is that a lot of folks in the planning realm, whether it's in crypto or outside of crypto, are really trying to sell repeatable solutions because it's easy to do so. It's very easy to go on to somewhere like YouTube and say, hey, here's this trust, you need to set it up, and hope that a lot of people watch it, call you to draft a trust for them in a very repeatable manner. What we're trying to do is bring options to the table, and options right now that we don't know whether or not they're applicable to you. And we won't know until we got some more information from you, the community, and the individuals onboarding to MCA, whether or not they're the appropriate option for you. Qualified opportunity zones are just another strategy that we're going to talk about today that gets into Reg D offerings, real estate development, some of the unique things that MCA is bringing to the table in that strategic partnership. So sorry to be long-winded there, Lennard. But a brief intro for Lennard. He can introduce himself. He's got a lot of background in this area, having participated in Reg D offerings himself, having done investment deals and developments himself. He's a member of our real estate and big business acquisition team at MCA, and he's going to be one of the individuals bringing some of those deals to the table as we move forward. So Lennard, anything you want to caveat with that as far as introduction goes?
Yeah, I mean, Blake pretty well covered it, but I would say, I've invested over the last 20 years, whether it be in single family, multifamily real estate, done quite a few Reg D offerings in the past, real estate development from the multifamily side, been involved in a few deals there. And then since COVID, but prior to COVID, actually got into this QOZ space and was able to do some deals there, and still doing some deals, obviously, in the QOZ space. Both from the fund perspective individually as well as with groups. So I think been able to play in the space a little bit, but it always comes with its hiccups. So there's a lot of things, moving forward that I think that we can help you guys with and explain this out a little bit more. So
one of the things that I had mentioned on the previous call, Lennard, is we've got an entire team within MCA that's really focused on what you do. And you're part of that team, obviously, and that team focuses on real estate developments, business acquisitions, and tax-efficient strategies like QOFs and QOZs that we're going to talk about in a little more detail. And they provide options at the end of the day to folks off-ramping from crypto. So when you're exiting your crypto and you've got a large capital gain, the question is, how do we mitigate that tax bill? And part of what we're going to talk about today is a unique solution to mitigating or deferring your tax bill that you would otherwise pay that year through a unique investment strategy. But it's also, how do you deploy that capital? And what we found both outside of crypto with the really high net worth folks that we service, but also inside crypto, is a lot of folks are very interested in deploying their capital in real estate or some business startup, some business acquisition. And that's something that we've done for a long time, as I said on the previous webinar, outside of crypto, and we're bringing that team and those options to the crypto community. So you're not obligated to participate in anything we're talking about today. And you don't have to make a decision as you come on to MCA as to whether or not you're going to participate in one project or the other. But the idea is that we're going to be involved with you to help make informed decisions as to where you deploy that capital when you off ramp, whether it's next month or next year, the next 5 years from now. How do you take that money, cut that tax bill, and deploy it in something that you want to create, passive income and productivity in on the fiat side? So to dive right into it, and Lennard, jump in whenever you want. I figured we could give a little bit of context as to what a QOZ is, because I know a lot of folks in the community, this is the first time they've heard that term. And like I said earlier, it's not something that's being talked about a whole lot. So I'll start with just defining it and giving a little bit of history context there as to how QOZs came to be. And then Lennard, maybe you can hit on the tax benefits, and we'll go down those rabbit holes just to provide context there. So let's rewind to pre-2017, before the Tax Cuts and Jobs Act of 2017. Qualified opportunity zones, known as QOZs, didn't exist. So they came into legislation in December of 2017 with the signing of the Tax Cuts and Jobs Act on 22 December 2017. And really, they didn't even exist then. Just the legislation created the opportunity for them to exist in this really nuanced tax code called 1400 Z-1 and Z-2 that didn't exist before. And it basically said, hey, states, governors, you can create these geographic areas within your states. And this goes over the entire United States, including Puerto Rico. And there's like 8,674, I think, QOZs. But they're basically just random geographic areas that if you invest within, you get certain federal tax benefits. And back in early 2018, the governors, it was actually, I think, March of 2018, they had to submit their recommended zones within their states that would receive these tax benefits that would become qualified opportunity zones. Those zones got approved, and now today we have the random patches, and you can pull up a map on Google of all the different qualified opportunity zones around the country that exist. There's a ton of them, some in more states than others, but you get tax benefits when you put money into these zones, whether you're buying real estate and developing it, buying a business. There's an incentive for private capital to fund these economic areas. And the first thing that we'll tell you is that some of these areas aren't great. The whole reason why they exist and the whole reason why this legislation came to be is a lot of these areas are economically depressed. So they're not the best areas to invest in, some of them. But what you'll find with a lot of them is that whenever they were drawing the lines that I was referring to earlier, they had to follow certain rules as to the median income level, the poverty level. And if the thresholds weren't met, those zones could not be qualified. They couldn't be qualified opportunity zones and come with the tax benefits that we're going to discuss here in a second. So all the governors had to follow these rules, and they were going off of 2010 census data whenever they were drawing these lines. This is something you and I talked about, I think, Lennard, is that they were going off old tax data because that's the most current they had. And you'll find that a lot of these zones, although they're considered economically depressed from a census data standpoint, which is what they had to go off of to qualify them, they're not economically depressed because there was a huge change between 2010 and 2017, 2018 when they were making the decision as to where those lines could be drawn within each state. And even more of a change if you fast forward to 2022. So a lot of these areas are not the best of areas to invest in, but there's also a lot that have come a long way or really aren't economically depressed when you look at them from an investment standpoint, even though they're dubbed economically depressed just from a census data standpoint when you look back at 2010. So again, we're not saying qualified opportunity zones or funds are the solution to your tax problem, but they come along with some really unique opportunities to mitigate and defer your tax bill as you're exiting from highly appreciated assets like crypto. So those zones, again, all over the country, anyone can invest in them. Now, if you get into certain deals that are within the Reg D space, then like we said on the previous call, you have to fall into what's called an accredited investor status. But the zones do not restrict anyone from participating in them. The project might restrict who cannot participate in based off of net worth, like we discussed last time. So again, just a brief overview of what they are. Lennard, do you want to speak a little bit to, and I can caveat it being the tax nerd on the team, the benefits. These zones exist. They came to be through the Tax Cuts and Jobs Act, and Congress is trying to incentivize the public to put money into these zones, and they're doing so through a tax benefit or number of tax benefits. Did you want to cover those just at a high level, and I'll caveat them with a little more nuance?
Yeah. So, I mean, briefly too, I'll just tell you guys how I kind of got involved in this QOZ space to start with. Was we'd invested in some single family homes years and years ago, and we had a lot of capital that was just tied up in those houses, and it wasn't really earning us a return. So we ended up selling those properties off and had some capital gains that we needed to invest. And I think that, the QOZ came to be about that same time frame as we were selling. But part of the benefits of that QOZ space was you got a reduction in your capital gains tax at the time. So at that point, when they first came about, it was 15%, right? Reduction in capital gains tax from the get-go, which was, that's a huge benefit. You get a reduction in capital gains tax that you owe on the front end. The other great benefit is that those capital gains taxes weren't due until 2026. And so at that point, the big benefit of that is you now have capital gains tax that you owe, but you can use that money to go out and invest on the front end and grow your capital before you have to pay any of those taxes. So it gave you kind of a nice window to go out there and get involved in the QOZ space, create some capital, use some of your capital gains tax still to invest, and then grow that business out for the long-term business or real estate deal or whatever you were doing. So that was a big benefit. And then on the back end is the biggest benefit, right? So whatever you go out and create in this space, you pay no capital gains tax on the back end of anything you create. So if you go out and you create, just simple math, right? If you go out and you create a $9 million or $10 million tax, capital gains tax, because you've grown a business or an apartment complex, or maybe it's even, it could be, anything, storage units, for example, something like that in these spaces, and you go out and you create a $10 million capital gains tax, you pay nothing on it. There's a $10 million capital gain. So huge benefits on the back end as you get 10 years down the road in some of these deals. And I think that, like you said, it's not a one size fits all kind of transaction, but I think there's some great benefits for people where this will fit in.
Yeah, I completely agree. And I think what you said, just high level, shows the real benefit of what these zones bring to the table, but also the complexity. There's a lot of rules here. There's a lot of different features, functions, and benefits. And a lot of folks don't know about them or don't get involved with them because there's a lot of nuance involved. And that's one of the things, like Lennard said earlier on, he started out doing on his own. And actually, we started working together as a team a couple of years ago in the space, really perfecting that rule book and making sure that the technicalities are followed, because there are some. But if you do it right, if you set up this fund correctly, which we'll talk about what the fund is in a second, there's a lot of tax benefits, and they come in those three different flavors. So first one, you don't pay a single penny in capital gain tax until 2026. And really you're talking about filing in 2027. So you get the time value of money there out of the gate. You sell $1 million in crypto today. Let's just do a round number example. And let's say it's all long-term. Let's say your basis is, basically zero, just because it's so highly appreciated. So let's say you got $1 million gain, all long-term. You would generally pay just to the federal government 23.8%. Those are the going rates, 20% long-term gain, and then 3.8% for the net investment income tax. So you're looking at $238,000 that out of the gate is going to Uncle Sam. That doesn't include anything going to your state. So you got $238,000 that you would ordinarily pay in the year that you sell the crypto, or in the following year when you file, that you don't pay. You kick that can down the road until 2026, 2027, when you file that tax return. So you're able to put that $238,000 to work, like Lennard was saying, and grow your capital and essentially use the IRS's money to make money in the interim of paying them something. Now, they still want some money on the back end, but they're giving you a real incentive as long as you put the money into the appropriate locations, which there's a ton of these qualified opportunity zones. You follow the rules, there's a real incentive to deploy that capital on a tax deferred basis and essentially use the IRS's money to make you money. So that's the first benefit. No taxes paid until 2026, 2027. The second one, like Lennard said, is you get a reduction on that if you hold it long enough. So generally, just where we are right now, in between now and 2027, it'll probably be 10% deduction on what you will pay in 2026 or 2027 compared to what you would have paid today. So 10%, not huge, but I mean, that's, if you're looking at $238,000, to go back to our previous example, that's $23,800 potentially shaved off the top of that as to what you will pay in the future. So those are just in and of themselves two huge tax benefits. And the last one that Lennard was saying, which is the real cherry on top, I'm surprised they approved in Congress. I think you and I had talked about that before, Lennard, a while ago, is the idea is that if you take a portion of your gain, let's say it's the $238,000 or the full $1 million gain in the example, and you roll it into one of these zones, qualified opportunity zones, let's say it's in, a storage unit development, like Lennard mentioned earlier, and you follow the rules and your intent is to hold that for the long haul. If you hold that for at least 10 years, and 10 years is a long time. So again, this is not for everyone, but this is tailored for a more long-term solution here. But 10 years, if you hold that investment for 10 years and then sell it anytime after 10 years, whether it's a day after 10 years or 20 years after you purchase it, there is no capital gain tax on any of the appreciation, 0%. So if you rolled, let's say that $1 million, and I know you would probably not roll the entire amount, but let's say you did, just for the sake of this scenario, you rolled the full $1 million into a development, and 10, 15 years from now, it's worth, I don't know, 2.5, which I don't think is unrealistic the way the, real estate's going these days. So 2.5 million, you're like, it's time to sell. I want to cash out. You sell that 2.5 million. You would generally owe tax on the gain of 1.5 million. So the difference between what you put in and what you sold it for. And you would owe 23.8% unless the rates were different then. 0% on any of that gain after you hold it for 10 years. So you would get the full 2.5 million and walk away with the full 2.5 million rather than getting hit with 23.8% or more on the long-term capital gain. Anything to caveat there, Lennard? Just as far as the tax benefits?
I think it's real important, the opportunity zone is, like Blake said, it's a really complicated, tax code structure. Not something you want to try to get into yourself, but there are some huge benefits associated with it. And when you look at, I don't care if it's real estate or whatever, like I've been involved in the past, like ideally you want to defer taxes as long as you can. You want to bump out, you want to get as much invested into whatever investment you're going into, right? So this is kind of that perfect scenario a little bit in some cases where it allows you to take your existing capital, reduce your taxes on the front end, defer taxes where you can, which is a huge part of the game. And then on the back end, pay no tax. And that's a big reason why a lot of people get into real estate, right? Is they take a W-2 income or whatever that they have to pay, pretty substantial tax on. And they parlay that into real estate investment or a QOZ or whatever that on the back end gives them some really good tax benefits. And I think that there's some good places to go with this, but it's like I said, it's not an easy thing for you to take on your own. I mean, they've changed the tax structure. I mean, they've changed the QOZ structure how many times, Blake, since it came out? I mean, for 2 or 3 years since it came out, we're still waiting on some of the finalized details of that.
Yeah, we were waiting on guidance and regulations to really dictate how these zones would work in very Congress fashion. And you find this even within the crypto realm. Congress will make some rule, but not really create the rule book that shows how the rule is going to be enforced or even the interpretation. And a lot of times they just punt that off to the IRS, like, hey, go figure this out. Here's the general rule. Go figure out how to implement it and even what we mean by it. And that's kind of how the QOZ world started off was, hey, we got this idea to where we want to give an incentive to folks that want to put money into economically depressed areas, but we really don't know how that's going to look or really what the rules are going to be. Go figure it out. So we waited around for some time after it was passed in 2017 to really figure out what the rules are. And things in that time changed and led to a lot of the complexities and technicalities that Lennard's speaking to now. One other thing just to mention, and then we can kind of get into the fund and how that fits into all this is, 1031s, Lennard. I know you're familiar with that concept and have done them yourself. Are really something that a lot of folks on the early on creation of the qualified opportunity zones, compared QOZs to. I can roll, my gain into another investment. That's like a 1031. In some respects it is, but it comes with a lot more benefits than a 1031 if you're familiar. And just to give you a background, a 1031 operates essentially in a way to where you can sell a piece of real estate. Let's say it's an apartment building. And as long as you roll the total gain into another like kind exchange is the terminology that the IRS uses, which generally means some other very similar investment. As long as you do that within 180 days, you can avoid paying capital gain tax on that gain. You can't do that from crypto. It's got to be real estate to real estate as of 2017. So still a benefit. We've done them. We do those. But QOZs, you can roll the gain from anywhere, whether it's crypto, real estate, stocks, bonds, and you can roll it into more than just real estate, which you're restricted to within the 1031 realm. So not just real estate development, but business acquisitions, which is something else Lennard has a lot of experience doing, is purchasing businesses, whether they're, businesses that have been around for a long time and someone's looking for an exit strategy, or it's a startup business. Rolling that capital gain into something like a cannabis startup company. I'm just naming some random things that have been thrown across the table before, is something you can do within these zones. Now, we don't always do them within the qualified opportunity zones. The terminology used in the tax community is you don't want the tax tail wagging the dog. You don't want to invest in something that has a tax benefit if you're not going to actually be investing in something that's just a good investment decision. So some of the areas I was mentioning earlier are economically depressed and you don't want to invest in them. But then some are. You don't want to invest in a bad investment just to get a tax deduction. You can invest in any bad investment and have a loss and then write that off. That's not a good tax planning strategy. So the foundation is really making sure, hey, are we investing in something that is worthwhile, that can create a passive income stream, and that is within an area that we think will be effective, whether it's a startup company or some real estate development. And if we compare that, which is really step number one, to, hey, can we put this within one of these zones so that every dollar of capital gain we throw into this investment is deferred, mitigated, and after 10 years, there is no capital gain on the sale for everyone that puts a dollar into these type of investments. So that's what this is about long-term. And that's what this is about just from an option standpoint, is having the ability to throw money into something ideally that reduces your tax bill, but can also be deployed to create a passive income stream in a various different manners, whether it's startup businesses, acquisitions, or real estate developments. So hopefully that's helpful conceptually. We got a few folks that are asking questions right now. And if you've got any, throw them out there. I don't know we'll be able to get to all of them or even go down any of them. But if we don't get to them on the webinar, we'll try to follow up via email if you've got any questions about this content. But that's what it is, big picture, is you're able to throw money into these zones and get a tax break for it. But what you have to actually throw the money into is these things called qualified opportunity funds. And these are essentially businesses that are set up, or a business, to receive the capital gain that the individual investor is putting into the business and trying to defer. So that's something we do at Mountain Crypto Advisors, is we set up qualified opportunity funds, and we're setting up one now for the crypto community. so that folks can put money into them and choose how that capital is deployed over these various options. But that fund is the entity, and it's generally a limited liability company that has its own bank account and registration, and the money is pushed into that company within 180 days of recognition. So if you're going to leave here with any information that's really important outside of the fact that, hey, there's some tax benefits to these QOZ things, leave here understanding the timeline is that when you exit from an appreciated asset, meaning you've sold it and recognized the gain, you've got 180 days to roll that gain into something like a qualified opportunity fund to get the tax benefits. So that's similar to a 1031. If you hit it on 181 days, you lose everything. So knowing when you've recognized that gain and making sure you keep a finger on that timeline is extremely important. It's one of the reasons why we're involved ongoing with everyone that comes on to MCA, is we help make those decisions as to how you're going to deploy that capital even before you've pulled the trigger. So before you have a stake that's coming due and you convert it to fiat or convert it to another crypto, we're going to have a conversation and talk about, hey, let's talk about how we mitigate tax for one. Let's talk about also how you're going to deploy that capital when it's in fiat form, whether it's in USD or in some other currency around the world, because we're working with a bunch of folks internationally. We're going to have that conversation proactively so you can make a decision prior to recognizing the gain. Hopefully that makes sense. Lennard, anything else to add? I don't want to draw it out too far, but any other context you want to add operationally to the qualified opportunity zones or funds or anything in particular?
Yeah, no, I would just say, there are a lot of pieces to this, and the fund, the opportunity zone fund that Blake was just talking about is kind of the initial piece of how this all gets started. And yes, it's you're setting up a business and all that, but at the same time, the funds that flow into there have to be capital gains, right? That all has to be, and to track that all on your own to see exactly what a capital gain is and how much capital gain you have to invest in the fund can get kind of tedious and time consuming. And that's why you want to have somebody like Blake's team on your side to kind of walk through that. But also an important part of that fund is that all that has to be registered with the IRS, right? They need to know that this is an opportunity zone fund. So it can't just be a registered LLC and it is what it is, right? There's still paperwork you have to fill out with the IRS confirming that all that stuff is, so there's levels of complexity there for sure. But I think, and that's just step one of the opportunity zone fund, to make sure that everything's operating correctly. But Blake, do you want to go into, how, once those are funded, I guess the next step, right, is whether it be an opportunity zone business. You kind of mentioned that earlier, but also I think businesses within opportunity zones have really been overlooked for the most part. I think that a lot of times people they're investing in real estate, they're doing apartments, they're doing whatever. But I think the biggest overlooked piece of some of the QOZ space has really been businesses. And I think people are, one, they're hard to find, right? If you want to go out and buy a business in a QOZ space, like Blake said, that these are depressed areas that don't have a lot of necessarily good businesses in them. But what we are starting to see is there are a lot of startups that are recognized or starting to develop themselves in these opportunity zone businesses for the tax benefits.
That's a really good point. I didn't think about to go into the weeds on that, but it's important for context. One, I don't want to overemphasize economically depressed, because we just don't operate in those areas that clearly it doesn't make sense to. There are economically depressed areas out that we wouldn't do any investment in for the same reasons that Lennard just mentioned. Then there's places like, Greenville, South Carolina. Yeah, Fort Worth. A lot of places that are economically depressed, but they're blowing up. And to Lennard's point, it's not just that real estate in that area is blowing up. They're blowing up with businesses. And these startup businesses, whether they're purposefully doing it or it's just by coincidence, are starting up within these zones. And after 10 years, if they sell their business, 0% capital gain tax, as long as they follow the rules that the IRS and Congress have set around these particular zones. So it's a great opportunity, not just for startup businesses to operate within the zone and have a really tax efficient exit strategy, but also for business acquisitions, folks that are looking to sell their business and to come in and pick up a business that has inherent and built-in tax efficiency for the long haul, not just up front, but for when you as the potential investor in this startup company or business that's been around for a while exits after a certain amount of time, getting a real tax break there. So yeah, that's a great point, Lennard, the business aspect, which is really, when it comes down to it, those are your options when you go into these zones. You've got, the option to buy real estate, and you've got the option to buy a business essentially, or a portion of a business. And that's really, the decision you make, and you can choose both, and you can buy different things in different QOZs or multiple things in one. But it's generally, are you buying like an old building and fixing it up, or are you buying a business that's already existed or starting a business? And those are considerations that we'll walk through. It's the same thing that Lennard and the folks on that team within MCA that are really tracking down the business deals and seeing them through completion are really focused on is, what is the opportunity within this space, and bringing that to the table, saying, hey, crypto owner, we see that you have, a stake ending, let's say it's Hex, a stake ending next month. Are you interested in any of these development opportunities or business acquisitions? And you get the opportunity to say, hey, that one looks cool. I want to take a little bit and push it into that one. Or that other one looks cool. I really don't like this one. Or they all look dumb. I want to push them into, something else, or my trusts that have been set up. So it's those type proactive conversations that we're going to have even before you pull the trigger and recognize gain. One of the questions asked was specific to the QOZs and, whether certain real estate qualifies or does not qualify. There's no rule within the QOZ realm that says you have to buy a particular piece of real estate as long as it's within the zone. There are rules that say you have to do certain things to that real estate if you want the tax benefits. One of the things is that you generally have to double down your basis, is the terminology used. You have to put, if you're going to buy an old beat up building, let's say, just to use kind of the economically depressed situation of what QOZs are sometimes, if you're going to buy an old beat up dilapidated building for really, really cheap, and you want to turn it into some apartments or a condominium or whatever it is, in order to get the benefits of the taxes that we're talking about now, you've got to put into that building generally what you bought it for, at least that amount. So if you bought it for, 250 grand, you'd need to restore it in a value of at least 250 grand to get the benefits that we're talking about. Now, that's if you buy an existing structure. If you're building something new, it's less restrictive. It's really, whatever you put into it qualifies generally. If you're buying a new business, there's no technical threshold you generally have to reach there. But there are these weird rules, like if you're buying just a vacant building, that the IRS, the Congress, the government wants you to put money into that, which makes sense because they're trying to incentivize private capital to uplift these depressed areas. They want you to put money into that building, not just buy it in order to lift up these economically depressed areas and get the tax benefits associated with the QOZs. But it's those type of technical conversations and considerations that Lennard's team really looks at as they're vetting these different projects, because there's a lot of them out there, and not all of them are good projects. We'll be the first to tell you that. It's important to vet the foundation of the investment before you consider any tax benefit. Hey, is this something that makes sense to invest in, ignoring every little bit of tax benefit that we've talked about now? And then if it is, then we look at, okay, is it possible to construct this new business or acquisition or real estate development within a QOZ to get those extra benefits? You think that's a good way to explain it, Lennard?
Yeah, no, I think that's good. I think there's a lot of intricacies in each QOZ, right? So, one of the questions was, is there best place or location about finding some of these QOZ areas? You said it earlier. You can go on and you can type in, qualified opportunity zones in Texas or, Georgia or whatever state you're in, and you can get the maps, right? You can see the maps. I think the hardest thing is really dialing in, what opportunities or development opportunities there are within those QOZs. And I think it gets really complex about what's going to work and what's not going to work, right?
Well,
and
you said it earlier. I mean, you can do this on your own. And if you're that motivated and you've got that amount of time to do it, then by all means, and we'll help coach you through it. But what you'll find is you'll spend just as much time trying to figure out, and find a good investment opportunity within one of these zones. And if you can minimize how much energy you're putting into that and rather have folks come to the table with vetted deals that they found all over the country or in places like Puerto Rico that you get to decide whether or not you put money into, that's a really efficient manner in which you can deploy your capital without having a lot of time sunk into figuring out what you deploy your capital within. And that's the exact same thing, not to beat a dead horse here, but it's the same thing we did. And I said on the previous webinar, we do for folks outside of crypto. That's exactly what the decamillionaires and the billionaires of the world are doing, is they deploy capital in a very private manner. One, because they like privacy. And two, you can get a lot of bang for your buck by, having a team come together, identify an investment opportunity or multiple, and figure out how to deploy that capital in a manner that's not just creating income, but is very tax efficient. And that's what we're talking about here, is taking that same concept, which isn't rocket science, bringing it to the crypto world, to folks that have highly appreciated assets, and turning around and deploying that capital in a manner similar to what we've done for a long time outside of crypto. So hopefully that provides some context there. And yeah, there's saying which is the best QOZ there's good investment opportunities in a lot of QOZs. There's some QOZs we'll tell you to steer away from, but like Lennard said, you can go on to Google and type in qualified opportunity zone maps, and you'll get a huge map of, the entire United States, and with all these different zones. And I'll tell you, I know Lennard's looked at them a lot too, but the maps don't make sense. I mean, they don't follow county lines. Like if you zoom into one particular city, it'll follow a stream and then a railroad. And it's the most, I don't know who drew those lines, but they were just following anything they could in some of these zones. Will QOZ maps be updated based on 2021 census? No. So what Congress said early on when these were developed in 2017, 2018 is they will not change unless there's some legislative act that would change them. So what they are now is what they will be until they cease to exist. And right now, they will cease to exist from an investment opportunity standpoint after 2026. So once 2026 rolls around, the opportunity to throw money into these vehicles no longer exists. If you've already got money within the qualified opportunity zone, you're fine. But there is a clock to get your money in to get the benefit, especially the long-term after 10 years pay no capital gain tax benefit that a lot of folks are putting money into this for the main reason. I mean, obviously deferring capital gain is great. Getting a reduction on what you will pay down the line in capital gain is great, but having a 0% capital gain tax after you hold an asset for 10 years, that's pretty substantial. Regardless of what you're investing in, that's a great tax benefit. And I'm sure you'd agree with that, Lennard.
Well, and one thing, Blake, that I think that I just to clarify too, I don't want people thinking that they have to have their own QOZ fund, right? I mean, yeah. Like the fact that we've created a QOZ fund, like if you guys are just looking for passive income, like you can have 100 investors or whatever in a QOZ fund, right? It doesn't just have to be, hey, I've got my own QOZ fund and I've got to go out and do my own thing, right? Once I've created a qualified opportunity zone fund, we can get investors just to dump in there, and it can be purely passive income. So you don't have to go out and search up these deals. You don't have to do that. So I don't want people thinking like, hey, like I have to take my own capital gains and do my own fund.
No. Yeah. I probably articulated that poorly. I was saying conceptually you could do that. There's a lot of time and energy and effort you're going to have to put into it just to set it up. But also to go down there and track down the deal and know the rule book, which is why most rich folks outside of crypto, just in general, don't do that. They have a fund created with other teams, other groups, other investors. That way they, one, aren't the one putting the total capital in. Other folks can contribute, but they don't have to worry about going out and finding the deal like you're referring to, Lennard, which is a huge time suck. Is they want folks coming to the table with vetted deals, vetted teams to say, hey, here's some options. And those options are going to change. depending on when you off ramp from crypto. There's not going to be some static, I don't know, storage unit development, like you were saying, Lennard, option that's always there. Maybe there is, because we're just doing one after another, because that's something that a lot of folks are putting money into, that and, RV parks. But these options are going to change based off of whatever deal is going on at that moment that you off ramp, which could be a startup company. It could be some real estate development, some business acquisition like we were speaking about before. But the idea that you got a team there built into MCA that their literal job is to go out and find the deals that you can turn around and say, hey, those are boring, or that's not something I'm interested in. That's the value that MCA is bringing to the table, and it reinforces the strategic partnership. You're not going to get that with any other attorney, CPA that's just trying to put together a plan for you. And hopefully that plan is effective over the tax, the legal, all these different areas that requires a lot of communication. Putting the plan together is easy. Building on that plan, knowing how to deploy the capital, create that tax efficiency long-term, and change it when regulatory or life circumstances change, that's what matters. And this is just one piece of the puzzle. This isn't a, hey, everyone, you need to start putting your money into a qualified opportunity fund. But we're saying that, hey, maybe it's something to consider. And we don't know right now whether or not it's something that you should do or that you shouldn't do, because we don't have a lot of information on folks that haven't onboarded yet. But it's one consideration that's not cookie cutter. And if you're looking for passive income, flexibility and deciding how that fiat money is deployed in private investment opportunities, and you're looking for tax efficiency with that, then maybe a qualified opportunity zone investment is right for you. Anything to add to that, Lennard? That's kind of high level.
Not really. I would just say, yeah, from a passive, like if you're looking at Reg D offerings, opportunity zone funds, all those things are going to provide passive income to you guys down the road. And I think that's the important piece. If you're looking for a monthly stabilized income, like whether it be QOF or a Reg D, once they get stabilized, these things are going to start spitting off cash flow to you guys on a monthly basis, which is the ultimate goal, right? Not only do you get the tax benefits, but on the back end, you're creating a monthly cash flow for yourself that is going to, replace income right down the road, where you're not working for it and you got a passive stream that's just helping you out long term. So.
Yeah. And not just that too, but also the tax efficiency through pass down of depreciation and other, tax benefits that come just from investing in whatever real estate that fund is purchasing. So it's not just the tax benefits we're talking about now from a capital gain standpoint. It's also, hey, a lot of these investments that you're putting money into that are going out and buying things, they're going to write off those things and they're going to pass down to the owners. So there's some built-in kind of inherent tax efficiency just in that structure itself. And also, liability protection. Again, this being something that is owned in an entity, not you individually, the crypto owner buying a piece of real estate and trying to develop it or start a business in your own name. This is something that's in a separate arm's length entity that has that own corporate veil around it to help protect what's inside of it. So there's a lot of benefits here, even outside the tax considerations and the capital gain mitigation strategies. When you're just looking at passive income, like you're saying, Lennard, asset protection, and making sure that you're deploying that capital in a manner that's efficient and in line with your goals and objectives. I think that's really, that's what this is about. We're going to do more webinars like this. Hey, this isn't something for everyone, but it's just talking about a strategy and option here for folks to consider if they fall in line with what the goals and objectives of this particular strategy is. And we're going to add to this so that, again, this isn't a cookie cutter solution. None of this is. As you come on, we're going to look at everything you've got and where you want to go. And where you want to go might look similar to where other folks go, but it doesn't mean everyone's going to take the same road to get there. So figuring out the avenue to get you from A to B, and when you got to change that avenue based off of life circumstances changing, that's what Mountain Crypto Advisors is. That's really all I've got, Lennard, unless you've got anything else. I thought this was really productive. We'll get to any questions we didn't get to in the call via email. If we if we can find some time, I think it shouldn't be a problem. But otherwise, I appreciate the folks attending and listening in. Anything you want to add in closing, Lennard?
No, I mean, thanks for having me on. I mean, I think, definitely stay in touch with us. I know that there's projects coming online all the time, whether it be in QOZ or the Reg D space or whatever it is. So, I mean, definitely stay in touch. And then obviously Blake's team too has your back on the tax side and planning and all that. So definitely keep us in mind. But if there's any questions or anything like that you guys want to throw in there at the last minute too, definitely do that. And we'll get answered, whatever we can get answered. So.
Perfect. Well, thanks again, Lennard, for joining.
Thank you, Blake.
And thanks for everyone for listening in. Y'all have a great day.